Hello, this is Ken Tomko with T2 Asset Management doing our monthly review of what's going on in the markets. As always, please don't use these for trading purposes. They are for information only. Look at what we're observing in the markets and doing in our portfolios. I always start with the weekly chart here of the S&P 500, and you can see here going back to here's the bear market in 22 that we had, and then it's been up until the end of 24, and then obviously the start of 25 was not a good one as we got off to some problems with the negotiating tariffs and such, and had the market fall at least temporarily about 20% intraday. Looks like we've gotten back about half of that so far. Had a nice bounce. It's informative. Sometimes I really like to look at the structure of the market and past support points and resistance points. And you can see here, this is the high from 2021 was about 48.18, and we almost nailed it to the penny here on the pullback. So one of the support points that we've potentially been looking at. Boom, there it was. It nailed it. Also, if you go back and put a bit of a trend line here on the weekly chart, also nailed that as well. So those are really important things to look at because the market sees them and other traders as a place to possibly put their money back to work and end the sell-off. So what we have is a market, and sure, I guess it's still a long-term up trend as this recovers. But if we really look at the short term here, the last couple of months, it's really not a good picture. We might just be getting a bit of a relief rally. So remains to be seen as we're coming up here to a point where, it could stop the market. This could just be a retracement or relief rally, and then we go back and try this trend line again. But for now, I guess we'd call the long-term picture as up still. If we come down here to a daily chart, gives us a little more detail. You can see this was the trend line that we had going down. That as a trend line that you had here going up into the beginning of 25 had broken. Then we got a trend line going down. So for the kind of the March, April sell-off that we had there, recovered, and now we've broken that. And I had put a few support points in here, places that we were looking at. We're currently right above that, just barely, but still above that, and testing looks like here the 200-day moving average on the up sign for. So for now, I'm sure a bit of a short-term uptrend, but I would not trust that we're done with all the selling just yet. But that's where on the short term we might say that sure we've broken the trend line downward and might be moving a little bit higher just to test to see if we're actually going to enter a bear market for the year, that kind of thing. So come down here to a little more detail. This is our 2-hour chart, and this gives us about the last 6 months trading the S&P 500. And you can see this is the downtrend that we were going through for March and April. And then that broke, and here's where we're looking now, getting certainly a little bit of relief off of there. People's portfolios a little bit better, and that's certainly nice to see. But again, as we look at the longer term picture, it could just be a bit of a bounce off the bottom. So remains to be seen. I would be waiting in cautiously, and we are. We certainly took risk off as we were selling down, and then put some back on as it looked like we might have hit a bottom. But I'm not. I don't have my foot to the floor on this one yet. That the trouble is over. If we come down here to some of our internal measures, this is the percentage of the S&P 500 that's in an uptrend. And you can see during the depth of all this in April, we were down to about 10% of the market was in uptrend. And certainly during most rallies, you would see it up in the 70s or 80s. And currently, that's where we are. So a good percentage of the stock market is participating in this rally. So that is a really good sign. This next one is the advanced decline line on the S&P 500. You can see, yeah, well, there's some volume coming into here that shares are advancing. It's not just a couple of stocks, Nvidia or something like that, holding up the market. This is actually a decent rally when you look at the internals. And finally, the bottom one here, this is the VIX, the volatility index. It's the price that traders are willing to pay for insurance for protective puts, option contracts that would protect their portfolio. If there were declines, that is certainly selling off. We were at a high of 52, and now we're at 22. So the VIX has come down markedly, which is also a good sign if you want to see a rally happen. So those are good things. I still am not entirely convinced that that the selling is over and that was just the dip for the year. Wouldn't be surprised to see us retest some levels, but you could also maybe argue if we come back here to a daily that we did that, right? That we bounced off the bottom, we retraced and came up here, but I don't think we're going to run off to the races to all-time highs. But that's just my guess. I certainly just follow along with the markets and have them tell me what they're doing. So that was that. A new thing I want to add here. I was just looking through this chart the other day, and I think it's very informative and something I'm think about including on the monthly update here. This just gives us an idea of the kind of stock, what the relative performance of different stocks in the market are. And if you say, okay, here, March, the start of the sell-off, this first one is a ratio of consumer discretionary stocks. So things that people would spend on if they were flush with cash versus consumer staples, buying soup and food and these kinds of things. It doesn't matter if there's a recession, you still eat. You can see here in March, that was really selling off. So it's a nice indicator to that. Next one down, that's equal weight to the same thing. But if we go to technology versus utilities, whether, okay, electricity stocks or Microsoft, Google, Facebook, that was certainly breaking down for most of the year and certainly broke down harder through March. So a bit of a bellwether there. Same thing, biotech stocks versus regular healthcare stocks, whether people have an appetite for betting on riskier stocks or just more basic healthcare things. That was breaking down as well. And then finally, another good indicator there is hotels versus utilities. Are people traveling, spending money, out having fun, or are they just laying low and making sure they're paying their utility bill, that kind of thing? That was breaking down in March too. So I thought it was an informative ratio to be looking at, and will likely be including this in future videos. We come here to interest rates. This is the interest rate on the 10-year U.S. Treasury, and right now it's 4.37. It's been in that same range I've described here for a couple of years. We're just staying in the mid-4 range, so nothing really to see there. A lot of speculation about what the Fed's going to do and such. But again, just keep staying in a nice range, and that's good for us. Come to economic indicators. The first one that jumps off, GDP growth rate. That's the first negative we've seen in a while, and so it's not really a good sign that maybe the economy is slowing down right here. We had been saying for the past year or so that it was slow and not great, but this is the first sign that we're seeing. Okay, maybe that is data that's saying we're getting a slowdown here in growth. And we come to non-farm payrolls. They're still pretty good. The jobs numbers, we're still having jobs added, so that's okay. But wouldn't be surprised if we're shrinking the government or any of that's going on, that we're going to see jobs go down as well. Inflation, relatively tame. We're in the mid-2s. That's fine. And then I also like to look at retail sales month over month here, and you have that's been pretty good. Sorry for the ad down there. I don't know what that is, but anyway, retail sales is 1.4 over 0.2 the last time. That's fine. So that's strong as well. But not strong, but decent. So, and then finally, if we go to the forward estimates for the S&P 500, this is analysts guessing what they think that earnings are going to be going out forward, and they're still strong. So analyst estimates are still saying that the economy is going, or the U.S. companies are going to be strong going forward. Finally, I do like to look at the valuation on the market. This tells us fair value about 20%. Or I'm sorry, 20 times earnings, where the S&P should be about 42.03. We're quite a bit above it. That last little pullback was getting us closer to where we should see a revisit, at least to the 20 line. That does tend to happen, as you can see, from time to time. It's going to come back and revisit that number. You just can't tell exactly when, but we had been very, very overvalued, as I've been stating last year. It came back a little bit, but is now bouncing again. So we'll see where that goes to. So just to summarize, give ourselves the big picture here. Here's the weekly chart of the S&P 500, and it's still in an uptrend, but definitely as it got ahead of itself, pulled back to a trend line to kind of normalize where we were. So we'll see where that all goes from there. I hope this was helpful and informative. I'm going to put up here our contact information. So if you'd like to hear any more about what we're doing for clients' portfolios or to protect them using some of these systems to try to take off risk and find the right place in the markets for clients, please don't hesitate to reach out. Otherwise, I hope this was helpful and informative, and we will see you at the next update. Thanks so much for watching.